Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about what wealthy families are changing, if anything. We're talking with Paul White. Paul is a family officer, relationship executive, and leader for Vanguard. Previously, Paul had positions at HSBC, and he has a CFP, and his coworker, Jonathan Kushner, who is client executive for family offices at Vanguard. So, Paul, I'd like to start with something that I found a little surprising to hear at the beginning of our prep for this. Vanguard is turning 50?
Yeah, Rob. It's exciting news. 50. You would think it's been longer given the brand size and impact, but I like to summarize all of the 50 years and its remarkable story into six simple words. Born from adversity, built with purpose. Really, it's such a powerful thing, especially when you think about Mr. Bogle's story, the markets in the 70s, and then how he purposely built us to really put our clients first. And I'd really like to say thank you to all our clients and let them know that we're more committed than ever to taking a stand for all investors. So thank you for being.
Yeah, I mean, it's an amazing history, right? From a commercial perspective and also from an intellectual one. So, yeah, it is definitely something, if any all your early listeners aren't familiar with the intellectual achievements of Jack Bogle or the commercial forays that Vanguard has made, do check it out. It's really quite a story from an industry perspective. So, all right, so I'd like to switch gears now a little bit to client perspectives because you all sit in a sort of a rare spot here as you have quite a few families who've utilized your OCIO services. And so I guess one thing I'm exceptionally curious about, particularly because it's so home based to CFAs, is asset allocation and whether or not we know if we're going through a secular change right now. So some would argue we are, some would argue we aren't. Change is sort of a constant, but I wonder if you're seeing that the families you work with are changing anything in their asset allocation or in their risk management, anything along that line. So Jonathan, Paul, what do y'all think?
Yeah, Paul, I'll let you do that. But before I even get into that, I just wanted to say really briefly, just because I think it's helpful context setting. So Paul and I are leading the family office team, which is in our advice and wealth management division,
Hmm.
and that's situated in our private client group. So we're leading the family office relationships. We also work with many of our peers who are serving ultra high net worth families that are investing on the Vanguard platform. I feel like it's helpful context to set just so that
Yes.
everyone understands what group we're sitting in and what our clients are thinking. But it's a great question about asset allocation. And Paul, I think maybe you want to take it away from there.
Great, great. Well, Paul, before you do that, Jonathan, that's an excellent point. So, typically speaking, when you're talking about in this podcast, are we talking about people who are the registered investment advisor range of clients, or are we talking about people with single family offices, et cetera, with like, let's say, 20 or more million dollars of investable assets?
Yeah, it's a great question. So it's the latter. It's single family offices. We have clients from 25 million up to billions
Hmm.
investing on the Vanguard platform. We also have non-family offices, just ultra high net worth families.
Hmm.
Some that are being advised by Vanguard advisors, and then others that are just self-directed investors that are investing on the Vanguard platform. But it's not any RIAs. It's all individual clients, family offices, and individual investors.
Great. So, everyone listening, you will call this by many different names: ultra high net worth, you know, intergenerational wealth, call it what you want. Numbers 25 and up. All right, sorry, Paul.
No, that's helpful and it's really good context. And really circling back to this question around asset allocation, you know, what we haven't seen is really sweeping shifts and changes. But I would characterize it more around the idea of fine tuning our enduring principles.
Hmm.
So think about it really this way. Our clients really are patiently preserving and thinking about the long term and really removing out the noise that's in the markets. And they're keeping their eyes away from definitely the headlines that are in the news because that's a bad idea for an investment strategy.
Yes.
But at Vanguard, in a sense, when you think about it, we have embraced and we have publicized and really tried to encourage our clients to think about what's our investment strategy and our investment goals and philosophies, and we have four basic principles, and that's really making sure that you have a very clear and specific goal. Make sure it's realistic because sometimes you can actually have expectations that are just not realistic and fitting in the market. We do believe in balanced and a broad diversification when it comes to suitable strategies for an asset allocation, minimizing your costs, and Mr. Bogle's favorite, which really is staying the course. But it's not staying the course and doing nothing. It's staying the course and making sure it's relative to your goals by being informed by with your asset allocation. So those are some of the major principles that we encourage our clients, and they've been adhering to it for the most part. Where they are making some prudent tactical pivots, I believe, is in the fixed income space. And
Okay.
that's something that I think it's important. And it has a lot to do more with the environment when it comes to higher rates for longer and they're more attractive rates on the fixed income side. So there's the element and there's an aspect of it that I think is important, especially when it comes to high quality credit securities or treasuries, and in particular municipal bonds when it comes to ultra high net worth families and those that are in the family office space. So they're thinking more about the tax brackets that they're in.
Okay, so yeah, I do actually want to ask you about cash management and fixed income in general in a minute. But before we get there, I'd like to unpack some of those principles you talked about there, because
Yeah.
the first asset allocation question has a lot. You said a few things there that bear some explaining. Diversification is one of the things that comes to people's minds when they're trying to set up a good asset allocation. Is how much is too much? So, how do you all approach that the diversification topic? Is it? I've heard it. It's you only need 20 stocks to get the variance out over time. I hear it 40. How do you all come down on what is a prudent amount of diversification?
Yeah, so Vanguard really starts from what we believe is the total market itself. So looking at the broad market, we don't do anything as it relates to, and we're looking at a market asset weighted perspective. So we're not thinking of taking some sample size or anything, smaller than what the entire market exists. And I think that this is our basic approach when it comes to equities, when it comes to fixed income, that's international. And when we're thinking about just equities overall, in Vanguard's philosophy as we've evolved, and I think Jonathan will talk a little bit about this, is we are thinking both not only now the public market, but we're also thinking around the private market. So when you're saying how much is too much, I think is that as big as the market shows and what we are kind of like showing as the full market size, Vanguard captures the full market. And anything other than capturing the full market is more of an active kind of approach to the market. So that's what we believe is the market really sets the benchmark for us.
Okay. Part and parcel to that, how about rebalancing strategies? Anything changing with that, or people staying course with their rebalancing policies?
Well, so here's where interesting around rebalancing. This is the idea of what we've kind of put in our fourth principle around discipline. And oftentimes people misunderstand or misquote, they kind of utilize this quick language of set it and forget it. And the reality of it is that it is a hybrid of what Mr. Bogle talked about, staying the course, but it comes to the point of what are you staying the course towards? And it's your goal. If your goal hasn't changed, but maybe the market has, it's like making sure you're adjusting towards your goal. And that's how you think about rebalancing the market, as rebalancing your portfolio versus trying to rebalance it or just set a target and leave it as is. And that's the element that we're thinking about, like rebalancing or having discipline is what we would call it. It is in the direction of your goals. So if your goals change, definitely there's something that probably needs to change in your asset allocation. But if it hasn't changed, staying the course makes a lot of sense. And then there are some definitely some tax strategies and opportunities around tax loss harvesting things you want to do. But those are more on the execution side and less on the strategic side of the asset allocation.
Right. Right. I guess, this sort of all boils up then to goal setting, which can be exceptionally challenging also, as you made reference earlier to reasonable goals. So, I guess one of the things there's certain life things that come along, children, grandchildren, et cetera, that change goals. But have you seen anything changing as these goals sometimes change with societal changes? As people, because wealthy people are just people too. They live in a society. So, have you seen any changes in goals that are beyond that, and how do you keep those in a reasonable range?
Well, the first thing is that I think what is changing in the market, and this is due to organizations like yourself or broad organizations that are looking at a more comprehensive approach to financial planning. So the idea that setting a goal and making sure that you're maximizing investment outcomes in today's environment, it's just not enough. And what we've actually found out is that it actually just doesn't work. And when we say that, what we mean is that you can pass on a maximum amount of assets without any type of an adjustment. When I think about the idea of who's going to be receiving the assets, what are your intentions and long-term perspective. Now you're taking an aspect, and what Vanguard coins, and we actually have a service for our family offices, it is called family legacy planning. So when you think about what are the resources and not just assets that you're passing along to the next generation, you think about financial resources, you think about networks that you might be passing along, you think about values that you're passing on to your family. So the planning concept expands much broader. And that's something that Vanguard actually, we've taken the lead on a number of occasions, and especially in our family office space, to say we have what we call a legacy service that we engage families in a much more comprehensive approach to financial planning and to legacy planning that includes more than just the assets. Because what we've seen is that the number one driver of success is actually communication. It's not legal documents. It's not having the best returns in your products that you might select, although that is a helpful driver. But if you're not communicating the goal and you're not communicating the intent for those assets and communicating it clearly to the next generation in dialogue and not in just directive, you're setting yourself up for failure. So I'd say making sure, and Vanguard's perspective is taking this step back and having a comprehensive view when it comes to financial planning.
Interesting. Interesting.
Yeah.
Yeah, that's exceptionally interesting, and also probably something that trips up more clients than the very wealthiest. Also, there are
Yeah,
a lot
well,
of
here's the thing. It's maybe not so much the clients that trip up, which I think the clients are dealing with it on an emotional side, but where it trips up is actually on the advisor or the relationship side. And
okay,
most advisors want to step away and say, "Look, I'm not a therapist. I'm
right,
not a counselor.
right.
My job is to maximize investment outcomes, and that's what I'm going to do." But again, it is when you have a firm and you have a team that is set up like Vanguard, the way we are set up, we think more comprehensively, we think longer term, and we actually integrate that idea of family legacy planning within our financial planning. So it is a concept that is actually quite comfortable, and it's not to say many firms out there that are not doing it, but I'm definitely confident that Vanguard, we have that embedded really within our DNA from the very beginning, because that was Mr. Bowles' intent.
Yep, yep. Okay, so let's shift gears a little bit and talk about the some of the subsectors of the asset allocation now. I'm particularly interested in what you all think and how the families you work with are thinking about alternative investments. There have been some absolute things I never thought would happen. The private assets came along and basically saved high yield before it just stopped issuing into oblivion. um, in, in April. There's still an awful lot of money in private equity chasing way too few deals. There's all this stuff going on. How do you all see this? How are you all reading this?
Yeah, it's a really, really interesting question. So we like to take a step back and like look at it at a very high level and then try to narrow in. So at the highest level, organizationally, we looked at how institutional investors have evolved their views on asset allocation over time. If you look 30, 40 years ago, most institutional investors were allocating mostly just to public stocks and bonds. But today, the paradigm has completely shifted, and we see institutional investors, although we're not serving them directly on our team, allocating anywhere from 20 to 50% of their portfolio to alternatives. So I think it shows a potential path for where private wealth clients may actually go. And this is one of the reasons why Vanguard actually entered the private equity market. But if you look at it, broadly speaking, and you say, hey, family offices, in our opinion, resemble more of an institutional investor. So our clients have already been making meaningful allocations to private equity and other alternative type investments. But the ultra high net worth families that we're working with broadly haven't really made that move yet. And they may not make the move all the way to having 20 to 50% of their portfolio in alternatives, but demand is starting to increase and they're asking Vanguard for solutions in this space because the demand is there. So I think there's the institutional investor path is a little bit of shows a potential for where private wealth clients may actually end up. So I think it's a really interesting segment for us. It's certainly we're getting much more questions now than we ever have before. And even honestly, sometimes on the side of clients wanting to know more about why Vanguard's actually entering this space, because for the longest time we've been the disciple of low cost index investments. So it feels like entering private equity is the antithesis of Vanguard's strategy. But there's honestly a ton of great reasons why we think being in the space is productive for our clients.
Yeah, Jonathan, let's ask that question actually. That's the first thing that popped into my head when you said
Yep.
that. Is that okay? So the fees go up, but what do you get for it?
Yep. Yeah. So again, starting broad and sort of focusing in a little bit, we have a great investment research team here. Did a ton of research on private companies, and one of the unique sort of aspects that made us enter the market was that our research showed that 96% of companies with greater than 15 million in revenue are private. And in 2010, private companies were only making up about 3% of the global equity market. And then in 2020, that's more than tripled to 10% at this point. So we're looking at private equity more from a diversification perspective. Vanguard has long championed you should quote unquote own the market when it comes to portfolio construction. It's becoming harder and harder to do that if you're only owning public companies. So that was a little bit of the basis of saying, hey, how do we get full diversification in the market, knowing that private companies are staying private longer? It's easier to access private capital, and there's no reason to believe that this trend won't continue. But again, at the same time, when we're doing this and with our private equity offer that we have right now, we're trying to come in and offer it at a lower cost than what's typically associated with the private equity model. So it really is a diversification play, but it's trying to do it in a Vanguard way, which is more of a low cost, easier way to access private investments.
Interesting, fascinating. So the I guess, it's exceptionally germane to the thought process of lots of wealthy families who probably had some kind of experience with private equity buyer of some of their shares, their primary business at some point. So it's easy on ramp there. I've also observed that there is a significant sort of long-termism that is shared by very wealthy families and endowments who famously by Yale were the first ones into this private equity realm. So
Yep.
it's makes it all kind of interesting. So let me shift gears a little bit because one area that's become exceptionally interesting in the more recent months with the increase in rates is fixed income and cash. so,
Yep.
so how are the families that you all work with thinking about that?
Yeah, again, another great question. So, just broadly speaking, cash is a major opportunity for us. Number one, because we think it's an area where we can help deliver great outcomes for clients, but also education. Even when we started to think about this and the questions that we're getting from clients, the cash industry is full of different terms and acronyms, and it can honestly make it kind of tough to understand. So, there's traditional banks checking and savings accounts, there's high yield savings accounts, sweep accounts, cash management accounts, money market CDs, you name it. It's an alphabet soup of different things. We try to simplify it and have clients ask three questions when they're looking at their cash or short-term reserve allocation. The first question is, what return am I going to get on my cash? The second is, how safe is my cash? And the third is, how easy is it to access and use my cash? So that sort of distills it down into three main buckets. When we look at return first, we did a national consumer survey earlier this year, and 57% of the respondents reported that their savings were earning less than 3% interest, and 24% were reporting earning less than 1% interest. So when we saw that, we said, hey, clients aren't even getting a return above inflation with where they're holding their savings. So to help solve that challenge, one of the things, based on client interest, we launched a Vanguard Cash Plus account. So it's an alternative to a bank savings account, but it has a more competitive yield than you'd typically see with a bank savings account. The FDI, we did in our research found that the FDIC average for traditional savings accounts was about 0.42%. Currently, the Vanguard Cash Plus account has a 3.65% APY. So we were seeing demand for clients that were coming to us saying, I want my savings to sit alongside my investments with Vanguard. But in order to do that, I want to make sure I have a competitive yield. And the 3.65% APY has been an attractive tool to get clients to consider Vanguard for their
Yeah,
savings.
yeah. So let's get into the hood for a second there, because how did you do that? The you can feel free to once again just us and 350 CFAs who are listening to this podcast, um, you have to take some risks to go up that far in the yield, right? So what'd you do?
Yeah. So interestingly, we have a program banking network. So typically, a traditional bank might offer a high yield savings account, and um, they're going to offer that product, and it's going to get clients $250,000 worth of FDIC insurance. Vanguard, the way that we've constructed it, there's a program banking network that we have access to. So not only does there's some wiggle room there on the yield. I mean, it does adjust over time, but by having the program banking network, we're actually able to even offer more insurance. So the Vanguard Cash Plus account has 1.25 million in insurance because of the program banking network that we have. So it is an interesting product. It has the account number and routing number that a client would traditionally associate with a bank savings account, but it's through our network of program banks that allow us to offer that product.
Yeah, that is fascinating. I mean, a lot of people call cash one thing. It's a lot of things, as you rightly said, Jonathan. That is a lot of things.
Absolutely.
Let me ask you this though. Looking at fixed income in the overseas markets is much more complicated because of the change of jurisdictional issues and some of the change in the way that accounting goes, et cetera. How do you all sit by your clients with that? How do you all see those things?
So from a broader kind of fund perspective, like I said, our broadest overview, and we're thinking about like this international allocation relative. The biggest and the first thing is one at the fund level. We are just looking at making sure that we hedge against the currency fluctuations. We are again looking at high quality when it comes to our fixed in and our global diversification as it relates to just our broader kind of concepts when it comes to the fixed income market, which is really again where our kind of like thinking is at a much higher and broader level when it comes to our clients as well.
Yeah, I mean, it's an exceptionally interesting market right now. Have to do full disclosure here. So before I came to CFA Society in New York, I was a bond rating analyst at Fitch Ratings. So, so, so I can get I can get terribly techie with bonds very quickly. But well, I guess that's kind of it. I think it's going to be really interesting to see how some of the things that you all have in place right now evolve over time. If we are in a higher for longer scenario, that's going to have a big impact on some of the stuff that you've done with cash management. I think the muni thing is interesting, and I think that it's going to be really interesting to see how your long-term planning for your clients is going to evolve. So thank you for sharing all that stuff with us today.
No, I do appreciate the time, and I would say definitely really from the start with Mr. Bogle all the way to our current CEO Salim Ramji, who I think really got it right on reflecting that successful companies really evolve with their clients, and over the last 50 years, Vanguard has done this with the purpose of taking a stand for all investors, treating them fairly, and giving them the best chance for investment success. So definitely happy to be here, and looking forward to hopefully another successful 50 years at Vanguard.
Yeah, yeah, successful 50. Well, so folks who are listening to this, if you'd like to hear some of these things, we're gonna have some more of these topics discussed on July 9th at the Mid-Year Market Outlook. You can sign up for it on our website right now. We will have someone from State Street coming to talk. I know he's going to be talking a little bit about the high yield market and some other portions of the bond market. And then also, if you like what Paul had to say today, you'll be able to hear him if you sign up for the July 21st event here at CFA Society New York. Both of those are available on our website at cfany.org. Until next time, I'm Rob Rowan, and this has been Compound Insights.